Hi guys, welcome to Marginally Sane. I am Farishta Khurana and I will be helping you understand various theories, concepts, and jargons in the world of economics. So, cutting to the chase, in this video, I will be talking about the theory of too big to fail. Now, sometimes what happens is a corporation or an institution in your country becomes so big and interconnected with so many other small entities that the country's economy or even the world economy at times cannot afford that institution to fail. Let me explain this with an example of a financial institution like a bank. In India, the central bank or the RBI has recognized three banks as systematically important banks: SBI, ICICI Bank, and HDFC Bank. Now, as we all know, SBI is India's largest public sector bank. Besides SBI's own net worth, many other small banks have merged with SBI in the recent past. To name a few, State Bank of Hyderabad, State Bank of Mysore, State Bank of Patiala, etc. Other than that, there are other key players in the economy like many corporates and individuals who have invested in SBI or have a direct stake in the company. So all in all, the SBI network is pretty widely spread across India. So now, whatever happens to SBI not only affects the lending rates and the share prices, etc. of SBI, but also of the banks connected to it. So if there is a rumor about SBI in the market, it affects all the connected banks, corporates, and individuals. Therefore, if SBI fails, or in other words, goes bankrupt, it would create a catastrophic ripple or a domino effect throughout the economy where all the related institutions are badly affected just because SBI is affected. So when the investors and the government senses any such potential failure of any such institution, it quickly steps up to protect it. The government considers the cost of bailing out or basically feeding money into these institutions against the cost of allowing such economic failures. The investors are willing to give big banks money at an artificially low rate. But that seems fair, right? We don't want any damage. I mean, how can this be bad? It is bad in the sense that it provides a safety net to such large institutions. When these institutions know that they have the government's and the investors' support, they are encouraged to take excessive risks. Their borrowing is subsidized, and of course, higher the risk, higher the reward. So when they take big risks, either they get bigger and bigger, or they are protected by the government and the investors. It's a win-win situation for them that makes them bigger and bigger over the time, and the cycle never breaks without any serious damage. This phrase of too big to fail became popular during the 2007 and 8 financial crisis that originated in the US. Some of the big companies during that time which collapsed were AIG Insurance Company, Fannie and Freddie Mortgage Companies, Bear Stearns, and Lehman Brothers. Lehman Brothers, even though wasn't that big, its impact was of course alarming. If we talk about the present scenario, to name a few, we have the Goldman Sachs, an investment banking company headquartered in NY, US. Barclays, a financial services company headquartered in London, UK. Then we have Credit Suisse, again an investment banking company headquartered in Zurich, Switzerland, and the Reliance Industries, which is a conglomerate company headquartered in Mumbai, India. So that's all for today, guys. Let me know if you want me to explain any other concept or any other theory or any other technical word that you come across in economics and you want me to make a video on that. And I'll also leave a couple of links in the description below for some books and some movies that you can watch to better understand the concept of too big to fail. So until my next video, please like, share, and subscribe, and do comment in the section below. Let me know which video you want to see next. Thanks a lot.